Good morning and welcome to our latest podcast. I'm Derek Barrow from Santander Asset Management. I'm joined this morning by our Global Head of Macro, Tactical Asset Allocation and Alpha, Hayden Davis. Good morning, Hayden.
Morning.
Okay, so last week we saw the US Federal Reserve raise rates by 0.75% for the fourth month in a row, and it's now up at 4%. How much higher do you think US interest rates could go?
Last week, as you said, the Federal Reserve raised interest rates by 75 basis points for the fourth time in a row. At the same time, Jerome Powell, the chairman of the Federal Reserve, gave two messages to the markets, one of which was welcome and one of which wasn't quite so welcome. So the first message was that the Federal Reserve now thinks that it can start changing interest rates in smaller increments. So the next rise is likely to be 50 basis points rather than 75 basis points. So that was greeted by the markets. But the second message that Jerome Powell gave was that the Federal Reserve now thinks it will have to raise interest rates a little bit higher than it had originally thought, which wasn't quite so welcome to the markets. The markets are now pricing in US interest rates reaching 5% by March, and we think that's about right. So the Federal Reserve has done most of the work this year, but it still has a little bit further to go.
Thank you. So a day after the Federal Reserve raised interest rates, the Bank of England followed with the biggest rise in 30 years, taking bank rate to 3%. At the same time, the bank forecast a 2-year-long recession and a doubling of the unemployment rate. Does this mean that the Bank of England won't have to raise interest rates much further?
Well, interestingly, the Bank of England produced two forecasts. Under one forecast, the one that's had a lot of attention, we get the so-called bathtub recession, we get a recession for 2 years, unemployment doubles, but most importantly, inflation, it falls. It doesn't quite reach the 2% target that the Bank of England has by the end of next year, but it keeps on falling in 2024 and 2025 and eventually falls to 0% inflation, which, being much below the Bank of England's target, is not what they want at all. And so that forecast is if interest rates follow the path expected by the markets. And that path is for essentially interest rates to reach 4.75, perhaps by the end of next year or in the autumn. Now, the other forecast that the Bank of England produced was if interest rates stay the same at the current level, so the current level of 3%, so they don't follow that path expected by the markets. And under this projection for interest rates, we still get a recession, but it's not as deep as the recession under the other scenario. We still get inflation coming down, but most importantly, inflation, once it reaches 2% in 2024, it stays there. So we don't see inflation fall quite as much. And so the message from the Bank of England, by drawing attention to these two different forecasts, was that it thinks that if it keeps interest rates at the current level or raises them only a little bit more, it will be sufficient to bring down inflation. Not to bring down inflation below 2% next year. It doesn't think there's much it can do on that kind of horizon, but certainly to bring inflation back under control by 2024. And in other words, it doesn't need to raise interest rates as aggressively as the market is expecting. So it certainly looks as if the bank is preparing the markets to take a breather. So maybe we'll see another rate rise next month, but then it will pause for breath. Now, we think that's wishful thinking. We think that with inflation at above 10%, that it takes more to bring down inflation. And in many ways, the Bank of England's statements and forecasts are in contrast to what we saw from the Federal Reserve. The Federal Reserve said, well, we're worried that we won't do enough to bring down inflation and would rather risk doing too much than risk doing too little. The Bank of England has said, well, we'd rather risk doing too little than doing too much. So in the short term, it looks as if the Bank of England will be pausing on interest rates. But we do think that eventually we'll have to start raising them again. And so we do think that at some point, we'll see interest rates rise to 4.75%. Now, of course, the wild card here is the autumn statement from the Chancellor of the Exchequer, Jeremy Hunt, next week. And we'll have to see just what happens when they actually come through. That will very much change the outlook for interest rates.
Thank you, Hayden. That's some fascinating insights there, and certainly lots for us to think about. So given the outlook you've just described, how have you and the team positioned portfolios over the shorter term?
Well, usually economists don't forecast recessions. They have a very bad track record of forecasting recessions. Now, as the listeners might know, the Bank of England started forecasting a UK recession for 2023 much earlier in the year. And in recent months, the Federal Reserve has indicated that it thinks it will need to engineer a recession to bring down inflation. Recessions are not good for equity markets. And so our position throughout the year, and we still maintain this, is that equity markets still have further to fall. At the moment, economists might be expecting a recession, but it's not obvious that equity markets are really priced for that. So a little bit more downside for equity markets, although we do think that perhaps the worst is behind us. As far as bond markets are concerned, we think that, for example, at these current yields, US bonds are looking about fair value. So we've turned a little bit more neutral on US bonds. But in other markets, such as the Eurozone or indeed the UK, where we think that central banks still have a little bit more work to do to bring down inflation. So in other words, they need to raise rates a little bit more aggressively. And we're not quite sure that inflation is yet peaking in Europe or the UK. There, we're still a little bit underweight bonds, although we can see a position or a time when yields are a little bit higher and would think that they were better value. And at that point, we'd move to a more neutral position in those markets.
Thanks, Aidan, for such a detailed update. Thank you for listening to our latest podcast. The views expressed in this podcast are the views and opinions of Santander Asset Management UK and do not constitute investment or financial advice. If you want to explore more of our views and insights, please visit our website at santanderassetmanagement.co.uk. If you require guidance or advice, we would recommend you contact your professional financial advisor. Thanks once again for listening to our podcast, and we look forward to speaking to you again soon.